We have some equity peaks to celebrate from yesterday's trade. You see the gap continuation 2019 and 2020 both had over 250 points in the E-mini Nasdaq, over $5,000 in profit, 51.15. And we know gap continuation 2019 struggled. What the story behind gap continuation 2019 is that when the pandemic came along back in April or March of 2020, we transitioned the 25K, 50K portfolio to gap continuation 2020. And so this is back in April. We had this strategy up 20,000 going back 12 months, and then it continued to do well up until October the 15th. Since October the 15th, it went through this losing streak. And so let's take a look at what gap continuation 2020 did. So we've had the 25K, 50K portfolio transition to this in March of April of 2020. And so you're sitting here in April of 2020, and it doesn't do as well until through October of 2015, but it continues to make equity peaks now. And so both of these strategies are good strategies. This one has a tight stop loss. They both have $300 stop losses, but the difference between 2019 and 2020 is that the 2020 version waits for less volatility, so it can use a tighter stop. If you use a $300 stop loss when volatility is still high, then you went through this drawdown on the 2019 version, still capturing this gain yesterday, and then in the 2020 version, you went through a little bit of a drawdown here, but new equity peaks. And how has this done over the last 12 months? It's one of the best strategies if you're looking on a 12-month look back. 28, 9, 10. These are with slippage and commission, $103 average trade profit, and only a 42.45 drawdown, which is low when trading one Nasdaq. 34% of the trades are profitable. In the 2019 version, only 28% of the trades are profitable. It's up 40K, but the stop is too tight for the current market environment, or has been, even though it captured that trade yesterday. So we've looked at putting in $700 stop losses on this, and I'm going to show you what each of these looks like with a $700 stop loss, because we have the gap continuation 2019 version with a $700 stop loss, but we don't have the the gap continuation 2020 version. It still has a $300 stop loss. Can we improve this with a $700 stop loss instead of a $300 stop loss? So still, this is a strategy that we really like. How is it done on the long and the shorts? It's done 22,000 on the long side and only 6,500 on the short side, and most of that was yesterday. So if we get some mean reversion into the type of market that we've been experiencing, we could get some more short side price action. It's hard to short this market. If you want a way to short this market, this is one way to do it with caution. So be careful with your shorts. Make sure you have stop losses and don't keep adding to losing positions. But I'm going to set this up now with $700 stop losses on each, and we're going to take a look at the difference on each of these. So we will go over that. I'm going to pause the video while we do that. So on gap continuation 2019, a $700 stop loss will actually improve your net profit as a percentage of drawdown. 658%, 191 average trade profit, up from 102, and your percentage profitability goes up to 44.88%. Your profit factor is 1.5, and your worst case drawdown actually goes down. And you have the $300 stop loss had a 97.50 worst case drawdown. A bigger stop loss decreases drawdown on this setup, and you see this losing streak here, and you see this bounce back day here. So now let's look at the $700 stop loss on the 2020 version. So on the 2020 version, we boost profits from 28,910 over the last 12 months to 35,400. Profit factor is about the same. Percentage of profitability goes to 50%. Your drawdown goes from 42.45 to 51.75. This number stays about the same. 681 on the other version with a $300 stop loss, 684. The benefit, though, is still the average trade profit goes from 103 to 151. So I love boosting average trade profit. Let's look at the equity curve now. New equity peaks. I love strategies like this because they give us opportunities to hit home runs. This is probably one of the best ways you can trade if you're looking for one strategy to trade. Trading a strategy like this where you can incrementally limit your risk and scale it. You could even set the max daily entries to 1, and then it gives you the opportunities for home runs like this, 51-15 on this setup, and that was actually yesterday. So in this gap continuation 2019, the largest winning trade is 72.40, and so that was at another time in the history of this. It also has more opportunity on the short side. On the 2019 version with the $700 stop loss, you have 27K on the long side, 30K on the short side. On the 2020 version, you have 26K on the long side and 8,400 on the short side. So you have to be a little more aggressive staying with it to capture the short trades. If you're only trading when volatility is lower, we have the volatility, the range filter in on the 2020 version. If you set it to true, then you'll take less trades. You'll get less net profit, less draw. You'll also get a smaller drawdown, and then it turns out that you get most of your profits on the long side historically, because the long trade is less volatile than the short trade. So that is how this strategy setup has been performing. And again, we transitioned to the 2020 version with a $300 stop loss back in April for some of the portfolios, and also still recommended the 2019 for some of the larger portfolios. That is the latest on gap continuation 2020 and the equity peaks here in the $300 stop loss version of the gap continuation 2020. And I'm going to go over in another video the equity peaks and some of the new portfolio setups that we discussed.